Hey everybody, I'm Leah College, an investment counselor here at RealWealth. Thank you so much for joining us for our live webinar. I'm expecting huge attendance and replays for this webinar because we are talking about what everybody seems to be talking about these days in the real estate investing space, and that is rising interest rates. I am joined here today by one of our preferred lenders, Highlands Residential. We got Graham Parham and Aaron Stelly both joining us today to be our resident experts on what exactly is happening with interest rates. And then they've got a great rate lock program that they're going to kind of premiere here today live for you guys. So thanks to you both for joining us today.
Thank you, Leah. It's always a pleasure working with you. And I will say I always enjoyed working with you. Not only you're one of the smartest people in this real estate environment, but one of the prettiest, actually. So I've never given you a compliment, so I figured I might as well do it now.
Well, thank you for that. I appreciate that. I love conversations like this. Actually, one of my favorite aspects of real estate investing, kind of the macroeconomic picture, fiscal policy. Everybody is talking about inflation. And really we know that the root cause of inflation is when we have too many dollars chasing too few goods. And so the Fed, I think, is obligated to respond to this inflation problem that we now have. And the way that they do that is by raising interest rates. So maybe it's good for our economy to have that kind of fiscal intervention, but it poses a new challenge for investors. We've got to figure out how to continue to buy and acquire property using great mortgage debt in spite of interest rates going up. And there is still a way. So thank you guys for joining us today so that we can talk through that, bring some peace of mind, bring some holistic context to this conversation today for our investors. So Graham, we'll jump right into it in just a second. If you can put up that standard disclaimer for me, we can all read it together in unison. Just kidding. We are going to talk about some strategies today that might not be appropriate for everybody on. So just keep that in mind, that there might be some investing strategies that are more suitable for your specific situation, your specific risk tolerance. As always, you want to consult with your own professionals, your accountant, a tax advisor, attorney, to discuss your specific situation. Past performance is absolutely no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of total amounts invested. So I and myself and Graham and Aaron, we're going to make our best efforts to bring you accurate information, but know that the possibility of errors does certainly exist. You want to be sure that you're in the driver's seat of your own due diligence when it comes to investments. All right, next slide. So Graham, I get asked all the time when I'm in conversations with investors, hey, so if say you were going to invest today, who would you be working with, or where would you be investing? And I get a little laugh every time someone asks that, because the truth is, it's not a hypothetical. I am investing in these markets and with these teams. In fact, Graham, I've got to mention, I hope you don't mind it, I'm working with you right now on closing a loan. One of the reasons I love working with you and your team is that you are also a real estate investor. You are also buying in many of the same markets that our investors are buying in some cases from the same teams. I know you and we've got future tenants who will be neighbors with each other. So we share a lot of the same kind of perspective when we're looking at deals, when we're looking at underwriting, and I always just feel really confident handing a referral to you guys. So I want to give you an opportunity before you get into kind of the meat and potatoes of today's class to just kind of tell us a little bit about yourself, about your business, and the experience that you bring for our investors.
Well, thank you, Leah. And I always love collaborating with you because I think we think along the same lines, and it's always just one big informational tool for both of us. So yeah, we consult quite often, and I encourage everybody to listen to what Leah has to say, because she knows what she's talking about. Okay, so about me, I've been out this crazy business for about 25 years. I kind of tried to get out of the business after the '08 bust, try to run from it, and I just kept getting sucked back in. So went back in and decided, instead of running from it, I embraced it. And when I did, my business took off. I am an investor, like Leah says. I've been doing that for about 17, almost 18 years now. I think the same thing with Aaron Aaron's been seeing these tax returns come across our desk, and we're trying to think, what do these people know that I don't know? Nothing. They're just doing it. And so I decided to jump in about 18 years ago and face first, and have not regretted it since. So I have not looked back, and it's been great ever since. And of course, most of the property, I'd say the majority of the properties are with the RealWealth members across the country, which I've really enjoyed. Aaron, I'll let you kind of talk about a little bit more about yourself.
Yeah. Thanks, Graham. So just to introduce myself to everyone, I work as Graham's production partner. Been with him coming up on 7 years now. And, as far as, my role here on the team, I'm more your boots on the ground guy, overseeing all our daily operations, making sure that our borrowers, that our referral partners, that everyone is kept in the loop, kept in a constant communication stream. Learning from Graham has been a great benefit, a great blessing. And pretty quickly in this industry, I also started drinking the Kool-Aid myself, and am also an active investor. So after seeing it all day long, every day, and seeing the success that our clients and borrowers have had, the freedom they've been able to open up for themselves. The proof is in what we look at all day long, every day for our clients. So really excited about what we have, to share with you guys today. I think it's going to be very beneficial for everyone. And, hopefully we can continue just to provide the good educational tool so that everyone can make informed decisions, especially going through this year.
Thank you,
I appreciate the introduction to both you guys. I want to real quick let everybody know we have a pretty big live audience with us, and we welcome questions. We're going to have a designated question and answer session at the end. So just pop open that question panel on the GoToWebinar control panel, send them in. Graham, Aaron, I'll monitor the questions and interject if on a relevant topic, but you guys just take it away.
Perfect. This talks a little bit about our production last year. Back the previous year, 2020, when the pandemic hit, of course, the rates dropped down quite a bit. Loans were falling from the sky. I think everybody in the industry prospered in 2020. And then, of course, in 21, we started seeing some increase in the rates. But the production numbers still held strong for our team. So as you can see, we did, 974 units last year, and we're probably on track to do the same thing this year. So if anybody in this business understands, that's a pretty high volume, which ranks us in, the accolades, as you see at the bottom, for the top originators through the Scotsman Guide, which is kind of our guide or Bible for the industry. It tells you who's who and what does what, and same with the National Mortgage News. Those magazine conclusions will be coming out hopefully here in the next month or two, which will rank everybody again. Do I really care about the rankings? No, I just care about doing a good job. So that's kind of what we've been doing last year. This kind of shows you our market coverage. The little star there in Texas, once again, yay Texas, go go Cowboys. But that's where we're located. So we're out of our corporate facilities here in Dallas, Texas. We do business all over the country. Oddly enough, probably less than 2% of our production is done in our own backyard. It's scattered all over the country, which is crazy. So that's our geographic. So if you're looking to invest in those areas, let us know. Why is the market changing? Well, I think we've identified it, Leah. It's inflation. When the economy begins to expand too fast, the inflation and asset bubbles can get out of hand, threatening our economy and the stability of it. Federal government has a mission to control it, okay? They're taking steps right now. One of their biggest tools of controlling it is, governing the interest rates, which to help cool down the economy. If we go back to COVID, back in March of 2020, the federal government put the gas on. They pressed on the pedal because they needed to increase the situation with our growth here. But now they're putting on the brakes. They were buying billions of dollars of mortgage-backed securities during that time period, and they continue to do so to help support, the industry. And I think they did a pretty good job with that. And then we started seeing things change right around the first year. So Jill, go to the next slide. This is kind of a good slide to kind of tell you where we were. Like I said, the government was purchasing all these mortgage-backed securities, quite in the tune of billions of dollars. They stopped purchasing in January, and I heard some rumors they're going to start selling it. Is that a good thing or a bad thing? We'll soon to find out. But what we are showing here at the two illustrations with the 2 bullet points, prior to the pandemic, which was March of 2020, we were actually 4 3/4 in our interest rates. Today, we're at 5%. So we're not that far off from where we were prior to the pandemic. Now, everybody that, let's say the novice, okay, the people that are seasoned, got several investment properties already and that were purchasing prior to that, they understand this. Some of the novice that are starting getting in this, the investment game, and they experienced the COVID, they refinanced their primary residence or whatever, hey, where's my 3% rate? Well, that ship sailed the first of the year, unfortunately. But I've been investing, like I say, in 15 years, and I can remember investing when it was in like 7 3/4. So, and we still made it work. And Leah, you and I know, and all the turnkey providers, we still made it work even when it was above 5%. So I want to pay attention to this chart. If you see on the far left, there's an interest rate. This is not a good barometer because we can't find a chart that represents investor rates. So we're working off owner-occupied rates. So if we see that chart, we can count an extra point on top of that. Okay. So let's go to January of 18. Actually, I take that back. Yeah, January of 18. And then you can see how it spiked up probably between January 18 and March 19. Look at where the top of that spike was, right at 5%. So you take that at a point, that was 6% in the marketplace just not too long ago, okay? And then we started seeing coming down during the pandemic, especially in, the far dip there in September of 2020. I think that was pretty much the bottom at that point. And then here comes the first of the year. And look at the increase of that little needle there. It's huge. That thing jumped a full point in 1 month, excuse me. I've never seen that kind of an increase, and I've been at this 25 years. I've seen it go up because I've lived this chart, as you can see it, but I've never seen those increases as high as it's been since the first year, okay? COVID, well, of course, we just talked a little bit about it. We have seen that COVID has had a significant impact on our economy, and because of that, we're starting to see that the economy is starting to change. I want to go down to bullet number 3. 7% inflation. That is huge. The government, they want to keep an annual no more than 2%, and here we are spiking at 7% in the last 12 months. That's the biggest we've had in 40 years, since February of 1982. So, the federal government, they're jumping in and say, okay, we got to put the brakes on and continue to control this. So they're doing everything they can. And I'd like to make a statement here, and this is my disclaimer, Leah. I was going to go on Amazon and order a big crystal ball and show it here on the video, and to get my hammer and smash the ball in front of everybody. But I didn't think you wanted the theatrics, nor did my wife want to pick up all the glass. But just think of that concept. I mean, there is no crystal ball. The feds have to come out with a plan and stick to it, okay? Right now, I think they're saying one thing and doing another. And when Greenspan was running the show, he would say something and he would stick to it. I just don't, and this is my opinion, of course, I don't think we're sticking to the plan. We are expecting several price hikes this year, 4 to be exact. We may have more, it depends. The feds meet about 8 times a year between now and year end. We just don't know what to expect. But I mean, are rates going up? Yes. You see the chart, they're going up. Okay. So I just want that, once again, a lot of these are factual. A lot of this is an opinion, but I'm not going to smash my crystal ball for everybody. Now, this is the biggest question on everybody's mind, which we hate to see, is what's going to happen with the outcome of the invasion from Russia on Ukraine. This is a very, very sad story. Everybody knows that. And I hope that the outcome is something a lot better than we expect. But what that does is has an effect on our market, okay? It has an effect on the stock market, has an effect on our economy in many different ways. So the investors that are in the market, they recognize some of the volatility that's going on and all the turmoil, they'll jump out of the market and onto the bonds, okay? Well, that's their safe haven, okay? Well, that's a good thing. When they do that, that helps the bond, that helps the pricing. A lot of people speculate because of that, if and when that happens, that we're going to see another refi boom. My opinion, don't expect that, okay? Because there's a lot of factors here that are involved that affect this economy through this turmoil. Oil. I don't need to tell the guys on this webinar, they're in California, you're already hitting $5, okay, if not more. Leah and I are still experiencing, what are we at these days, Leah? I don't know, before we're down on the 4s, right? I can't
I'm
even
the wrong
remember.
person to ask. I just fill up, Graham.
I haven't driven in a couple of weeks because of my surgery, so I don't really know, but I'm sure we'll probably hit $5 before the next month and a half. You know, that's gonna affect our oil prices. That's gonna affect all types of different prices, because the federal government, when they raise the interest rate, they raise the Fed rate. And this is where a lot of people will gauge their businesses. This is where banks gauge their lending abilities, because you know we borrow money to lend. We secure the loan. We sell it off to the investors on the secondary market, to Fannie Freddie. They acquire the loan and they run with it at a certain risk level that's being priced throughout the loan. You know, this is usually lowers the rates, but only for temporarily until the market settles, which means that we may experience with this whole ordeal, when the investors do jump onto the bonds, that we may see a temporary reprieve in rates. How long that'll last, I can't tell you. There goes that crystal ball and the hammer again. It could be temporary. It could not happen at all. Once again, I just don't know, and I would love to say that I do, just to help put everybody at ease. But my theory is that we are going to continue to see an increase in rates. How much? Don't know that again. Okay. We as a company and as a lender recognize some of the challenges that investors are dealing with right now. Rising increases in rates, rising increases in pricing for purchasing the properties. I saw a statistic the other day. In 1 year span on a new build property across the country, we're up 21%, which is huge, huge. And if anybody's experienced with dealing with some of the builders these days, they have this thing called a price increase. And none of us like it. We hate it. We complain about it, but we still hold true and we continue on with the construction. And then they start looking back going, okay, then we have to deal with this rate thing, okay? So we recognize that. So we came up with this product, or this program, if you will, that addresses new construction only, okay? So make sure we're real clear about that. And what that means is any of the RealWealth providers that they are hooked up with on the build side, you know, this is for them, because the builders are toting the note through the build. At the end of the build, that's when we as a lender step in, fund the loan, you know, acquire the property, turn it over to the investor. They put a tenant in it. This is not for a strategy where you might have purchased a piece of property. You own the property, you've got a construction loan going on it, and then in however many months down the road, it's going to be completed. You're going to convert that loan into a construction, a permanent loan. This does not apply to that. This applies to this any of the RealWealth providers right now that are offering new builds, okay? So with this, I'm going to kind of turn it over to Aaron. I'm going to let him run with the specifics of this program.
Sure. Thanks, Graham. Yeah, so as Graham said, you know, the outlook this year, as far as rates are concerned, as far as everything that he just elaborated on, is, you know, can be a little daunting. So, you know, the whole purpose of this program, whenever you know, the higher ups, Graham, whenever we were getting together in our company and trying to figure out something that we could provide to our borrowers as a benefit, as a tool coming into this year. So as Graham stated, this is for new construction only, and really the best way that we like to think about this extended rate lock program is it's almost like an insurance policy. We don't know what's going to come for the rest of this year. We don't know if a few months from now we're going to be in the 6s, possibly higher. As Graham said, we've already gone up 1% essentially since January. In just, you know, 45, 60-day period, we're already up 1%. So we're really excited about rolling this out. This has been seen in the industry before, but the key is only with owner occupied. To our knowledge, no one out there is doing this non-owner occupied on these investment new builds, and that's kind of, you know, the whole key behind it. So as we kind of take a look here at the several bullet points, it is going to be for the 30-year fixed, which is, you know, pretty much what all of our clients do go with. And you can see that we have various different lengths that we can lock our clients into. Typically, the rate lock that, you know, we currently use, you're looking at 35 or 50 days. So right away, we've got 120-day, a 6-month one, 270-day, and even the full year rate lock. So essentially what this does, you can see kind of after every period, there is a percentage that is essentially added to the rate. How that works out, for example, today, 25% down, you're looking in the ballpark of 4.75%, where we're at today. If we were to proceed with, say, the year-long locking program today, we'd take that 4.75%, we'd add 1% onto it, so you're at 5.75%, and that rate is secured for a year. The market goes up to 6.5%, you're protected, you know, in all of that. If the new build might not quite take a year, you can look, we have a 6-month option. There, take the 4.75, add the 3/8 to the rate, so you're at 5 1/8. We're already almost there on 20% down. So that is, you know, not far off at all. So all of these, depending on the progress of the build or the status of the property, these give some great options to the borrower. And if we can go ahead and jump to the next page here.
Before we jump to that page, I'd like to say something. Sure. Leah and I have experienced this new build process. And if the builder, the provider, Leah and everybody else says, okay, we think it's going to be done by this day, you might as well add at least another 30 days on it. Am I right, Leah?
Yeah, at least 30.
At least 30. So just to make sure you understand that if the builder says, okay, I think we're going to get it done by this day, and you want to do the 120-day lock, well, then I'd go for the 180. Just to be safe. Sorry,
yeah,
Aaron.
I would add, Graham, probably confirm that permits have maybe been received on the property before maybe you consider a lock like this, at least the 180 one, because permitting in a lot of markets is taking 6 months. So what you don't want to do is burn through your whole rate lock period and construction hasn't even started. So there's still some, I think, reasoning that you've got to kind of look at timelines to select one here.
And you're absolutely right. And you and I have lived this, so let's talk a little bit. And some of the biggest build markets that we're working in right now is Florida, okay? Florida is terrible when it comes to permitting. They're just so slow, and several different markets. I've lived it, I've breathed it. I've still got a build going right now that was promised to be done by Christmas. And here we are, 1st of March. And I'm waiting not only the permitting side, but on the inspection side, because most of the properties down there use septics, and we have to have a septic inspection. And they normally run 30, 45 days to inspect. Well, that was supposed to be done back in December. Here we are in March. So there's all kinds of things that can slow this build down, and it's real. The cost or the availability of product, availability of wood, windows, all kinds of different things that can slow the build down. Consult strongly with the builder on this just to make sure. Sorry, go ahead.
Yeah, and the only other thing I would touch on this slide is I do want to put out there that, you know, the borrower, as always, will still have the option to buy down their rate with this program. So say we're at 4.75 today, they want to pay, you know, it might be a point to get to that 4 3/4, or excuse me, 4 3/8. We can do that, no problem. We just add 1% on from that point. So if they're at 4.375, they're now at 5.375. So as we said, this is essentially, you know, an insurance policy for the borrower. The whole purpose that we're offering this is, as we all know, you know, we're kind of in the business of risk being the lender. And what we're trying to do with this program is eliminate the risk that the borrower is going to have on this property as they wait out the build time. So part of that to use this program is we do require upfront deposit. And I would recommend thinking of this almost exactly like earnest money. So in order to take advantage of this program, what we do require is a 1% upfront deposit. So if the loan amount is $200,000, that 1% is going to be $2,000. What's required on the day that we lock in the loan, we ask that the borrower actually overnights that deposit to our corporate office. We'll provide them with all the information they need to know. Corporate office confirms receipt. The key is we do have to get that in within 72 hours because we are holding that rate. It is costing us money to hold that rate. That's why we do want this deposit. As soon as we get that deposit in, we just hold it. And fast forward 10 months, 11 months, 12 months, the property's built, we go to close. You'll see that deposit credited back to you on your final closing disclosure, just like you would earnest money or something else you had already paid out of pocket. So to put it very simply, the deposit is required up front. However, once we go to close, the borrower gets that money right back into their pocket. If for any reason, what I do want to point out, if for any reason the borrower does decide to cancel, we start it, we get the deposit, 6 months go by, life issues happen, they have to back out on the transaction. If that does happen, we are required to keep the deposit. Again, because holding this rate for 6, 8, 10, a year does cost us money as the company. We're willing to take that risk because it's a great product to deliver to our borrowers, but the catch is we do require the deposit. Again, ultimately, you get it back whenever the loan goes to close. So I'm sure a lot of people are already wondering, what if rates go down? You can tell from me and Graham's sentiment, we don't really expect that, but we always want to be prepared for what is kind of going to happen. Again, no one has the crystal ball, but what's awesome about this program is there is a one-time float down option allowed. And how it works, to put it real simply, is once we're within 30 days of closing, the borrower will then have the option, if they would like, to exercise the float down. What that means, if we were initially locked, say we initially locked at 4.75% for the year-long program. So our true rate is 5.75. 10 months go by, we go to close. A few weeks before that, we want to take a look at the float down option. Well, we're not at 5.75. Rates have miraculously stayed at 4.75. Can I lower my rate to that? Yes, we can do that. So if for any reason rates stay the same, go down, once we get 30 days out from closing, we will have the option to match the market rate or beat it one time. So it's an awesome tool to take advantage of while you have the protected rate for, up to a year. At the same time, if 11 months go by, rates have dipped for whatever reason, we can still take advantage of that. You still get your deposit back at the end. You still have current market competitive rates, which is really why me and Graham are so excited about this program. It's for these new builds, especially with kind of these unknown timelines, it can give the borrower a lot of reassurance, a lot of peace of mind, knowing that rate's protected, knowing that worst case scenario, I'm at 5.75, 5.5. It's just a great thing to offer.
So quick question that I thought of, Aaron, in the scenario where you've utilized the float down once,
mm-hmm.
and you're coming up towards closing and rates are even lower,
mm-hmm.
Can you make the decision to just forfeit the 1% deposit and relock at the lower rate?
Absolutely. So that would always be an option as well. So yeah, exactly what you just said. We already exercised the float down. Oh man, rates somehow dropped even lower, and they really want to take advantage of that. Yes, we would have to keep the deposit, so there would be that catch. But yes, we could essentially restart the loan on our end, set it up as a new file, lock in at current market rates, and essentially treat it like a brand new file that just started on that day. So yes, thinking through it that way, or worst case scenario, that will always be on the table for the borrower.
That's a great question, Leah, and just to make sure that they're clear on what you just said, is that let's just say the borrower bought down the rate, okay? They paid a point, bought it down. And all of a sudden the market itself is better than what we had when we locked it, buying it down. Well, we don't have to charge that 1 point, which is great, okay? So this is always to your favor. This is one huge insurance policy is what this is. And a lot of people are freaking out about the rates. If they want to have peace of mind and go to bed, knowing that when we go to close and however many months down the road on my new construction build, I'm still going to have this or better. This is a perfect insurance policy.
Yeah, I want to talk through one more scenario that I think our investors could find themselves in, and that is these price increases on the contract. You know, when a builder comes back to you and needs to renegotiate the price, you have the option to terminate and walk away, right? However, if you have also committed to this rate lock extension program and you're coming to the decision of, do I just terminate this agreement because I no longer lock the price? Now you need to factor in the fact that you might be able to get your earnest money deposit back from the builder, but you would be forfeiting the earnest money with the lender if you chose to terminate that contract. Is that right?
We have a couple options. Aaron, I'm gonna let you go to the next slide.
So let's go ahead and skip past this one. That's just going into a little more depth on the float down. We'll come back to this. I want to, since we're on the topic here, go one more if you can, because I want to address exactly right here what you just talked about, Leah. So exactly what you just said. As the year goes on, these price increases, you know, are inevitably going to happen from time to time. What's awesome about this program is we have a 10% tolerance, 10% in wiggle room. If they need to increase that loan amount, increase the purchase price, we can increase our loan amount accordingly. Typically, that's really not achievable on a normal loan. Sometimes it can throw off the pricing. Sometimes it can, result in maybe some additional cost to the borrower. But in this case, they allow us 10% wiggle room to increase it so we can maintain that 80% loan to value for the borrower, or that 75% loan to value. So it's just another great reason, why we're excited about this program is we do have that wiggle room there. If we go back one slide as well, one thing I did want to mention is even with the year-long program, 6 month, 9 month, we can still even extend it. There is a cost associated with it, but we can even extend it past that. So we're talking an additional 75 days potentially on that year-long program. So, we could have the rate essentially protected for, over 430 days, which is just great. So, if whenever, borrowers are reviewing this and trying to decide, and of course, we're always available to help kind of offer our advice and our take on it, but, should I go with the 6 month or 9 month and, unforeseen delays? Even if it runs out, we can still extend it at the end of the day. So you're not getting hung out to dry. You're not losing the great rate that you took advantage of 6 months ago, a year before that. All right, let's jump to the next slide. Did you want to add anything on that front, Graham?
No, the next screen is going to answer part 2 of Leah's question.
But can you give me an example with this slide? I'm having trouble understanding the 10% margin there. Is that means that if the price is adjusted within 10%?
Yeah, the loan amount itself can go up 10% and we can still honor it, okay?
Okay, without me having to bring any additional money to the table at all.
Exactly.
Okay.
And then all of a sudden, and before this next screen comes about, I'm gonna give you a scenario. Let's take the community you and I are buying it, okay? There's 30 houses in there. The builder's got them all. He's building, for everybody. And all of a sudden, something weird happened. Oh my God, we're in a flood zone. I don't want this property. And the builder says, well, I got one 3 doors down. It's not in the flood zone. You want that one? Sure. If everything's the same, we can actually let them change to another property, which is pretty cool. And I don't think anybody will let that rate itself, even in today's world, before this program comes out, that you can move that rate from one property to the next. We're going to allow for that to happen, which is kind of cool.
Wow. Is that only when it's in the same community, or when we have these builders who are building the same spec house and a million different infill lots?
As long as it doesn't tolerate more than 10%.
Okay, cool.
Yeah, it's very cool. Okay. So that's available as well. Now, as far as the bailing part that you're talking about, when you end up, I want to bail,
Mhm.
keep in mind, this is a high risk program that we're doing to accommodate this economy, okay? There's no risk on the borrower's part. They've already paid for their risk. They've given us a deposit, okay? The only risk to them is they walk, they lose that deposit. Just like a lot of times in the earnest money environment, there's a lot of sellers that they don't want to give back that earnest money. Well, because it cost us money to do this program, you know, before even they make the decision to walk, that's why we don't let them have that earnest money. Yeah, they can walk, but they lose that 1%.
Right.
Okay.
Right. So Graham, I'm like naturally wondering if like your willingness to offer a program like this is a reflection of your confidence that interest rates won't go above 5.5 or something. I mean, is there any, can we like glean any confidence factor from you guys just simply based on the fact that you're willing to do this?
That's a great question. I posed that to the head of our secondary department and the management of our company. And that's why it comes down to they are willing to take this risk. This is not a shoot from the hip program. This is a well thought out program. There is risk involved. If rates jump to 7%, it could cost us money. It really could. Okay, so yes, this is once again, this is a program that we feel confident based upon what we think that crystal ball and hammer is going to do for the next year.
Okay.
I personally think that the rates are going to continue to rise. Will we hit the 5.5 to 6? Never know. We just don't know. But even if we don't, this program addresses the fact that that's okay.
Mm-hmm. I'm assuming that you guys are going to cap the number of borrowers that you'll let do this, right?
Another great question. I had to get special permission to do this on investment properties. Like Aaron mentioned earlier, most of the rate lock extension programs that are in the marketplace are mainly for owner occupied. I don't know of anybody out there doing it for non-owner occupied. I'm sorry, what was your question again?
Now you put me back on the spot. I've already gone to the next question in my
If we were going to be capped, Graham, if we were going to be capped on how many of these loans
Thank you,
we could
Aaron.
do in our
Oh, yeah, great question. And I'm glad you brought that up simply because we're testing this, okay? We're kind of not really making up the rules as we go, but we're going to see how much of participation that we get on this, and we judge it against our risk.
Mm-hmm.
Will we cut you off? No, we're not going to cut you off until people, once people lock in. Well, there's no reason for us to do that.
Yeah.
7 months down the road, all of a sudden we're up in the 8s or some crazy stuff like that. Are we going to reevaluate this program? Probably so. Okay.
Yeah.
Now, the other good thing that I think that I'm going to go back to management after probably a month or two is say, look, let's take a look at this on not only new builds, but let's take a look at it on rehab properties, okay? Because the good rehab providers that are in the RealWealth network, we trust, okay? If they say it's gonna take 30 days, it may take 60, that's okay. We trust that they're gonna complete the property to our satisfaction or the appraiser's satisfaction. Are we there yet? No, I have to walk before I run, but that is on the drawing board. I would love to release that in a couple of months, but I can't guarantee it at this point until management gives me the green light.
Right.
Okay. What's next? If you're involved in a contract now and you have those timelines that the builder has provided to you and you want to participate in this program, you can call myself or Aaron or even email us at the Parham team. We're always standing by. I mean, Aaron and I mean, if you can't get me, you can always get Aaron and vice versa, or anybody in our team. We can be very responsive to the email. So if you want to find out more information, we can send you out a PDF that outlines this program as well in a simple PDF. But I think it's something of consideration. We've had this program, believe it or not, for about a little over a year. Never had any reason to talk about it. Okay. All of a sudden, here comes January and the thing goes to the roof. It's time to talk about it. And thank God when they did, we only had it for 180 days for a year. And then they took it to a year and I went, okay, let's talk about it. And that's why we're here today. So yeah, just let us know, give us a call. Here's our information. And Leah, I'm sure you got plenty of questions to deal with.
Yeah, I think this is a good place to plug the fact that we're recording this webinar and we will archive it on the Highlands lender page, which you can find under resources when you're logged into the RealWealth Realty portal. I think we're also going to get this one up on YouTube. So if you're watching this on YouTube, come join us at realwealth.com, become a member, and join the club. get to leverage the relationships that we all have in all these different markets and with great people like Graham and Aaron. Graham, I love this program. I think it's creative, which I always appreciate. I find that, well, if people have been listening to me over the last 2 years when I've kind of shared my opinion, I've multiple times I have said, I think when we look back on the post-COVID era, when we identify what the opportunity is, I've been saying, I think we're all going to look back and say the opportunity was the interest rates. They bottomed out. How many of us refied things, with rates as low as they did? How many of us tried to scoop up as much as we could, like just recognizing that rates were extremely low? The challenge to that dynamic is that we all get really spoiled to ridiculous rates and really healthy pro formas that we just become, myself included, entitled to. But the reality is, even when rates were as low as they were, I mean, you and I both, I know, are on the phone with investors trying to convince them that it was a good deal then.
Yeah,
And so I got to give a little bit of tough love to investors that might be watching this who found reasons to not pull the trigger and buy investment property back when rates were in the low threes. Today, they want to blame it on the interest rates, but I would encourage you to consider that interest rates might not be your problem if you had trouble committing to really fundamental deals back when they were in the threes. So I'm just going to put that out there. I love this program because I think it helps us kind of sidestep and be creative. This is what investors, I think, are known for. This is what I love about this investing strategy, is that the market's going to do what the market's going to do. But we get to look at it with a fresh perspective, try to make the most informed, educated guess that we can about what's ahead of us, and leverage creative solutions and go for it, So I love that this kind of fits right there within that wheelhouse.
perfect. I couldn't have said it better myself. I don't want to say derogatory comments, but if all you care about is rates and the rates have gone up and that freaks you out, you probably don't need to be an investor anyway.
Right.
But that's just
I mean,
me.
I say all the time, dollar cost average when you purchase, right? You buy high, you buy low, you're dollar cost averaging. Think the same thing with rates. I mean, you're getting some high, you're getting some low. At the end of the day, and I was just having this conversation with my husband last night. We were talking about how, okay, you're committing to some properties now, you're locking higher rates. If this is a long-term purchase, we know markets are cyclical. We know rates will eventually come back down. Just make a little mental note that you need to refinance this loan when rates come back down again, potentially. And there you go. You've bought back that margin potentially.
100% agree.
Okay, I think the next slide is questions. Correct me if I'm wrong, Jill. Yes, here we are. Okay. So we've had quite a few questions come in, and forgive me, some of them are more kind of backing up. They're not exactly related to this specific program. They're more in general to the services that you guys provide. So let's knock those out first.
Sure.
The question is asked multiple times here about whether you guys do non-conforming loans, such as portfolio loans, or for investors who've already exceeded their 10 Fannie Freddie loans.
The answer is no. We are a Fannie Mae lender, okay? I've got 42 properties, so I'm outside the Fannie box. I faded out a couple years back. There is life after Fannie, but we personally we stay in the 10 box. So no, I can turn you on to some other lenders. Leah, you can do the same thing for people that do, some non-recourse commercial portfolio type lending, and there is life after Fannie, so don't freak out.
Yep. So this question is in the same vein. A couple times it was asked, do you offer loans to LLCs?
Great question. About $1 for every time that was asked. I'd have a lot of money. Fannie Mae and Freddie Mac does not allow us to fund a loan in any type of entity. LLCs, S corps, limited partnerships, anything other than your individual name and or a family revocable trust. Okay. Now, as an investor, as working with me, you're going to get two hats. One is a loan officer, another is an investor. As an investor, this is not a loan officer speaking. What I do, and probably 99% of my clientele will do, if they're still inside the 10 box, they'll go ahead and fund the loan in their individual name. I encourage them, if they want to, flip it into the LLC, which they have the right to do, I would encourage them at least wait 3 or 4 months. And the reason being is once we close and fund the loan, we deliver it onto the secondary market. The people that are buying these loans, they're going to go through and they're going to do a due diligence. They're going to re-underwrite the loan. They're going to pull all types of different reports. So you want to let the dust settle, okay? And that's why I say give it 3 or 4 months. Get maybe an invoice on your belt from the new servicer. You kind of says, okay, maybe it's time. And then at that point, get your deed of trust and your LLC documents, send it over to an escrow officer or an attorney, and then have them, reassign it into the LLC. But I probably would encourage you to not pick up the phone and call the servicer, because you're going to get your $8.50 an hour person saying, well, sir, we may have to call this note. I've been doing this for 25 years. I have never seen a note call due. You stop making payment on loan? Sure, they'll call it. Other than that, they just don't care.
Okay, Sharon asked a question which you answered in your answer to that question. The question was, do you service or sell the loans? You guys sell them, to reiterate what you just articulated.
Both. The majority of my loans, and I say my loan, all of the investor loans we do is 100% to Fannie Mae, okay? And when we do that, which means we are going to service that loan probably 99% of the time. We do have some other aggregators for the rest of the company, loan officers that do a lot of primary residence and so forth, that we can sell to other aggregators. But for these investment loans, it's 100% to the Fannie Mae, which we're going to service. Now, is that not to say sometimes servicing platforms change and they sell off? Sure. I talked with the head of our servicing department just a couple of weeks ago, and she's crossing her fingers thinking we're not going to sell any more loans off of our servicing platform this year. That does happen, but from the standpoint of servicing, yes, post-close, we have a fabulous website post-close. As far as a tool, I personally have several loans with our company. It's really easy, user-friendly.
So there's a question on here that's kind of in nature. The question is, are there investment loans or options available today with no points? It seems like every loan option has a point now. And I think some of that might have something to do with who is servicing those loans, right, Graham?
Not necessarily. Points are basically buying down a rate. Some lenders will try to attract the quote ignorant consumer, and I say ignorant until they get educated. Okay, my rate today is 5 versus 5 1/4. Well, I want the 5. Well, the 5 is going to cost you the point. Well, what about the 0 point? Well, that's going to be 5 1/4. Well, I want the 5. Okay, it has a cost. Okay, and one of the things, and I looked at the market today, and I noticed mainly on the 20%, not necessarily the 25, but on the 20%, what we try to do and what we've been doing forever up until, gosh, what would you say, Aaron, the last maybe 20 days or 30 days?
Yeah.
Is the majority of our loans have been at 0 points, which means we're not charging any points. Mm-hmm. The way points work, typically on a normal day, we try to lock in at 0 points. But if you want to buy a point on a normal day, 1 point will get you 1/4% better in rate. I've run these numbers backwards and forwards. 1/4% better in rate for 1 point buy down is a 5.11 year return. I try to get it within a 3 to 5 year return. There's some days it may be better than 1/4. It may be 3/8 or 1/2. Then at that point, myself or Aaron will say, okay, here's an option to buy it down, which makes sense. Then your return on that point could be 2.8 years. Mm-hmm. That to me is a makes sense. So we don't ramrod points down their throat. We do not. We let them pick and choose.
Right. I think that's great, and something everybody should be doing is run the math on the point scenario to find out if it makes sense. Don't just always assume cheapest is what I want. Right. Least exactly. Money out of pocket is what I want. And Graham and Aaron and their team can kind of guide you through how to do that math to kind of know the right selection. But Reedy, I mean, to get at what I think is the root of your question, if every lender that you've been talking to is telling you that there's no such thing as investment loans without points, that's not true. So reach out to Highlands because they've got some no point investment loans, but you might want to buy a point anyway.
True.
Okay, let's get through some more of these here. Rory wants to know, do you guys do cash out refis on existing rental properties?
All day long.
Mm-hmm. Has the current interest rate factored into the expected March Fed rate increase?
Where we are today,
That's all I have.
where we were supposed to have a rate hike 1st of March. It was supposed to be a 50 basis points increase. Yesterday was a crazy day in the market. The Fed said it's only going to be at a quarter, but a lot of times what the Fed say and what the investors do are two different things. We saw no decrease in rates yesterday. Okay, so where we are today, basically, we're on a 20%. We're roughly about 5 to 5 1/8, and on the 25%, like Aaron said, we're anywhere from 4.625 to 4.75. Okay, will that go up and down? And where we are today in this crazy market, yeah, it's probably going to go up and down, probably more so up. That's just my gut.
All right. Some of these we've already addressed, so I'm just working through them here. Okay, Anad wants to know, is there any fine print or a clause in your agreement to protect you guys in the event that interest rates are up at 7 or 8%, God forbid, when it comes time to close?
We do have an agreement, a signed agreement from both parties on this rate. If you choose to go with the rate lock extension program, we send you out a document that spells it out exactly the way we spelled it out today, and they sign it. So there's an agreement between you, a legal agreement between them as well as us.
Mm-hmm.
And just to elaborate on that, if the rates do shoot up to 7.5%, 8%, we're still honoring the, that's the whole risk that it is a risk, for us if rates do continue to rise. So yeah, absolutely. There's no fine print that's going to avoid it if rates just keep shooting up.
Good. All right, this one says, this is a great product. Thanks for sharing. I recently spoke to a lender who said a few major lenders received notice that new restrictions will be in place as of March 18th, and that perhaps it's a good idea to hold off on putting offers until we know about what happens. What do you think about that?
I haven't heard any rumors about new restrictions whatsoever. I don't know where they're getting that information. We probably would have been notified if there's any future change in guidelines or anything of that nature, but I haven't seen anything.
Yeah. Okay, here's a general financing question. So among the mortgage products, do you recommend a 30-year or a 15-year? Also, do you recommend 20 or 25% considering the current interest rate market?
For people in California that have purchased owner-occupied primary residence on a jumbo product, the ARM products shine very brightly, okay? There is a differential there from a 5 to 7 to a 30-year product. Even on 15. And sometimes on owner-occupied in the Fannie world, the 15 does shine a little bit better than the 30. But because of the adjustments on the investment properties, and we're still dealing with an inverted market, the 15-year fixed rate is very close to the 30, but you end up paying points where you can't with a 30. The 5 and 7, it's even worse, believe it or not. I mean, you could probably go down maybe a quarter or 3/8 on the rate because there's only so much margin in that product because we can't zero it out or do a 0-point pricing on that. You may end up paying a couple points or more just to get that. So I haven't sold an ARM product in 7 or 8 years. I just haven't. Doesn't make sense.
Yeah, and then as far as to follow up on kind of the 20 versus 25, going back to kind of the rates that Graham just outlined, typically you will almost always edge out a better rate with that 25% down option. So if the borrower has, a little additional cash to throw down to put it on it, and it's all going to be unique to the borrower themselves, right? If they want to, if their goal is I'm going to put 20% down, go buy 4 properties, well, they're going to want to, do it that way. Versus 25, it might only be 3 properties. So every situation is going to be unique. but at the same time, me and Graham are going to be there to, walk them through the numbers every time when we go to lock a loan or address any questions about it. It's exactly what we do. Run through that math, give them all their options, crunch the numbers with them, and find the best game plan moving forward.
Yeah, I find that my last couple deals I've been doing more and more 25% down than I used to. And I think some of my logic, I mean, one, I always run the math, but some of my logic is also knowing, one, how long it takes to get a new build to the closing table. And so knowing, while I wait for the next deal, like, where am I going to put that extra 5%? Like, if I have an opportunity that gets me great returns, to commit that money to this deal now that I have now, like, I've kind of been deciding to do that, commit the money to the deal that I have now. Graham, Aaron, correct me if that's like a major novice mistake, but that tends to be more my frame of reference these days.
Not at all. Matter of fact, every time we discuss this with a buyer, and I'll tell them straight up, okay, here's your 20% down, here's your 25. Here are the numbers. Here's the principal and interest payment. Here's how much extra it costs for the 5%. You have to ask yourself, if I have the extra coin, would it make sense for me to do the 25%? A, I'm going to get a better rate, better cash flow, better equity position. Or
Yeah.
B, do I want to save that 5% because I think I'm seeing a property down the road I might want to take? Well, then hold on to your 5%. Do the 20%. Don't worry about that differential. Go take that 5% to the next property. It's always their choice, and we'll present it that way.
Yeah. Okay, here's a good question. Is this program only available for our builders, or is it for all new construction, any outside of network builder?
All new construction.
Okay. Do you have any programs that bundle multiple properties?
Those usually are portfolio or commercial grade loans.
Yep. Can this program be applied to second home or vacation home loans?
Yes. Okay. But let me tell you a little bit of something about what people don't know about the second homes these days. Is second homes before, well, I guess coming up now, probably right around now, we're seeing some changes. You could put 10% down on a second home, and you could get owner occupied pricing, okay, which is good. A lot of people took advantage of that. The only thing is you would have private mortgage insurance. Now, our administration says, you know what? We don't like people with money. And those people that are going out buying second homes, we just don't like them. So what we're going to do is we're going to make the pricing equal to investment property pricing. Crazy, I know. And that's that we are here today. So if you take it, so the benefits of looking at a second home versus an investor, the negative is that on investment property, I'm going to give you income back on your DTI ratios because it's an investment property. I'm not going to do that on a second home. Well, if I'm going to do a second home, the only benefit is doing 10% down, but you're going to have actually a little bit higher rate, because if we're doing 20% down on a second home, it's the same price as it would be on an investor. If you're doing a 10% down on a second home, the rate, believe it or not, is actually 1/4% higher. So that whole second home thing, there's really hardly any benefit anymore.
Yeah. All right. This question says, I have no Fannie Freddie loans, not even a primary residence, but I have 10 plus non-QM loans. Can I still qualify for Fannie Freddie loans?
Aaron, I'll let you take this one.
Yeah, so it's a little bit of a tricky situation, but at the end of the day, whenever we pull the borrower's credit report, if those 10 loans end up reporting on that credit report, Fannie Mae is then going to require us to factor in all 10 of those finance properties into the borrower's portfolio, and thus we would be tapped out Fannie-wise. So we've seen it a variety of different ways where borrowers have done similar things like that, and sometimes they are personally liable for it, and some way to the credit bureau, so those are reporting and we have to factor them in. If they're not tied to their individual name, if they're not reporting on their credit report, then we would not have to count those against them. So it's one of those things that when it does come to that, we always ask, send us in what you have outlining it, and we have all our underwriters in house. Give me today, let me check on it, I can get back to you. So it's kind of a case by case situation. But a good rule of thumb is, if it is reporting on your personal credit report, then we are ultimately going to have to count that against you.
Let me take that one step further. Most commercial lenders, like you've described, don't report. They just don't. Okay, I've got all these loans that are in that category, and hardly none of them show up on my credit report, which is a good thing. And I see this happen all too often, where people had, I don't know, say 10 loans, and they're all Fannie, and they wanted to take away the Fannie opportunity, or take away the fact that they're pigeonholed in the 10 box, and let's go to this commercial lenders over here and let's refinance it in my LLC. Okay, that's all good, but you got to take a look at the note. This has happened many times over the course of the years, is that a lot of these commercial lenders, even though you're putting it into an LLC, thinking it's a commercial grade loan, it's given me opportunities in that Fannie slot. Go look at the promissory note. If the promissory note says that the LLC is the guarantor, and your name is not on that promissory note as anywhere near the guarantor, then the answer to the question is, then you should be fine. If your name is on that promissory note, like Aaron said, we're going to count it against you, and that'll bust the Fannie Mae.
All right. I think that about wraps up the questions. If you want to advance to the very last slide for me, Jill, we're going to end on this last friendly one, because we'd be crazy if we let the two of you guys get off without getting your personal opinions about investments. So Aaron, I'm going to start with you, and then Graham will go to you. The question is, where are you buying investment properties nowadays? Where do you see the numbers making the most sense?
Yeah, so I'm actually, like I said, being a little bit greener to the industry. I've actually got a new build going underway, going more along the lines of an Airbnb model, actually out in Oklahoma, oddly enough, kind of in the Broken Bow area, but really like that. And then, that, like all new builds, it's gotten a little delayed, but once that finally does wrap up, I'm really intrigued with Florida. Sure, some of the new builds are taking some time out there, but it's just seeing the returns on those, seeing the product out there, it's very attractive to me. I know Graham's got several underway in Florida itself, so he's been we get updates from Borrower, I get some inside updates from Graham, so I think definitely Florida is where I'm interested next.
Very cool. Aaron, I know Broken Bow. I didn't tell you, I'm from Dallas originally, and I
Oh,
see all
right
my
on.
Dallasite friends going up to Broken Bow all the time. So I'm imagining that's going to be a great vacation rental to use and
Yes,
generate revenue.
exactly.
Very
Aaron,
cool.
you'll have
Okay,
to
Graham.
share her information on how to rent that out so she can run up there with her husband.
Right,
Yeah,
right.
exactly.
I
Graham,
guess
where are
it's
you
my
at these
turn.
days?
Well, let me tell you where I am and where I'm going. I don't really have a preference of where I'm going. I cheat. Leah lets me cheat, okay? And the reason why I cheat is I get word of things going on in the industry where people on this webinar don't, okay? Hey, there's an opportunity with a new build over here, or this market has something over here, or hey, there's a rehab going on over here. So I get a lot of these opportunities where I cheat. So I really don't have a preference, but where I am and where I'm going is I'm in Dallas, Houston, Kansas City, Cincy, Memphis, Birmingham, Montgomery, and then probably about a half a dozen cities in Florida. Leah and I are closing out one up in Cincinnati within the next week or so. I've got one going on in Memphis, Tennessee. Believe it or not, it's a new build. And then I've got several going on in Florida. So I do like Florida. I think Leah would agree as well.
Yeah.
If they can just slow some of the pricing down in Florida, because what's good about Florida is the rents are going through the roof, and that's great. I love that part. And so, matter of fact, I bought some right at a year ago, and I've got some information from my management company. Hey, okay, they're expiring. What do you want to take it up? We're taking up somewhere between $100 and $200 a month. Oh my God,
Nice.
we couldn't do that 3-4 years ago if we tried, which is great. So I mean, once again, that's Florida. In other markets, not so much, but that's what's going on in Florida. It's crazy down there. It really is. But I like it, as Aaron says, some good quality products, good builders down there. It's a fun market down there.
Yep, I find myself, even though as a Texan, I have all the reasons that I need to want to invest in Texas, but I find myself always going back to Florida just because the underwriting is so much easier and those rent to value ratios are really nice, and you don't have that huge property tax bill to overcome each month. So Florida's kind of kept my attention too for the time being. But Graham, I have to say now on that really nice compliment, but I want people to be assured that like this is the power of a network. This is the power of connections. Like we all talk all the time. We're all investors too. We're all seeing opportunities. We're trying to help each other. There's plenty of opportunities out there. The difference maker for Graham, for Aaron, and for myself is that when we see deals, we go for it. And so connect with RealWealth Network. We've got our ear to the pavement. We know what's happening. I have been looking at Florida so much that I can just kind of automatically know what's reasonable for cash on cash return, what's typical for rents. I mean, we just know these areas. So by connecting with an investment counselor at RealWealth, by connecting with our property teams, like you get the insider information that we all have and that we freely share with any of our clients. So that all being said, guys, this was a super fun webinar. I'm really, really appreciative of you guys for putting your heads together and coming up with a solution that allows our investors to keep buying, because we ultimately think that's what everybody should be doing right now. Buy, buy, buy. There are opportunities. So really, thanks to you guys for putting your heads together and for tapping on the folks upstairs to get them to offer products like this for us.
My pleasure, Leah. Always a pleasure.
Absolutely.
All right, guys. Thanks so much. We'll see everybody next week. I think we're talking to Charlotte next week. So if you want to look at some new construction inventories there, be sure you join us next Thursday too. All right, guys. Take care. See you later.